Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing MPLX's stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Marathon Petroleum owns a general partner and majority limited partner interest in MPLX. MPLX is a midstream company which owns and operates gathering, processing, and fractionation assets. Fractionation is a separation process of oil. It also transports crude oil, and it also deals with logistics infrastructure. Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $25 a share, and they have 1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive and growing free cash flow each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they did have positive net income every year except in 2020. Revenue is the sales for the company, and that grew at a really rapid pace from 3.7 billion to 6.1 billion to 8.6 billion, but it did drop a little to 8.2 billion in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Examples are cost of labor and cost of materials. The difference between those two numbers is their gross profit, and their gross profit seems to be growing quite a bit from 1.3 billion all the way up to 3.6 billion. It did decrease a little in 2020 when compared to 2019. That's mainly due to lower revenue. Below that is their operating expenses. Examples are depreciation and insurance. Then below that is operating income. They tripled their operating income from 2017 to 2020. That's really impressive. Then below that is the interest they receive on their investments minus the interest they pay on their debt. Then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. And that was a big negative in 2020. That brought down their net income to negative 700 million. But I would focus on operating income when looking on the income statement. That's a better indicator of the company's operational business, because below operating income is not part of their main business, and it can really skew the numbers. Since this company is a master limited partnership, they don't pay much in taxes, almost no taxes at all. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the company does have positive free cash flow each year. Sometimes Yahoo Finance doesn't pick up all the details. The company had about $2 billion in CapEx, so they had a little over $2 billion of free cash flow in 2020. So it does look like the company's issuing a lot of debt. They issued $5.3 billion in 2017. They paid down $2.3 billion, so they added $3 billion of debt. The next year they added $6 billion. Then the next year they added $2 billion. Sometimes companies add debt even though they have positive free cash flow. They pay almost $3 billion in dividend payments, so it looks like they're using debt to pay their dividend payments. They also added $500 million of capital stock. When a company issues capital stock, that increases the shares outstanding, making your shares less valuable. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. And this company generates lots of operating cash flow. We'll look at 2019 since they have all the information there. You could think of operating cash flow as net income converted to cash. because net income is your accounting profit and loss. It's not actual cash. And the way you calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. They pass through a $300 million gain onto the income statement, which increased their net income, so we have to minus that out on the statement of cash flows. They also pass through a $1.3 billion depreciation expense. That brings down their net income, but it doesn't affect cash flow, so we add it back here. They had a $1.2 billion asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. In 2020, they reported negative net income, yet the company generated $4.5 billion of cash flow. In 2020, they passed through a large asset impairment. An asset impairment is a non-cash item, so it can make your net income look really bad for a certain period. That's why I think operating cash flow is a better indicator of a company's health than net income, because operating cash flow is actual cash, where net income can be manipulated by accounting. Let's look at the capital structure. $13 billion of equity, $21 billion of debt. They're 38% equity, 62% debt. So they're pretty leveraged. And their WACC is 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $39 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $32 billion. We divide that by 1 billion shares. And we get a calculated stock price of $31. They're trading at $25, so they're trading at a 21% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $37 a share, so they're saying the stock is even more undervalued. This is the stock price the last 5 years. It was pretty steady for a while, around $30, but then it dropped a lot in March when the market crashed. It has come up a bit. It's still trading at a nice discount relative to its pre-March highs. This company pays a nice dividend, 11.2%. And to calculate the dividend, you could just multiply their last dividend payment by 4 and then take that number and divide it by the stock price. They paid out 141% of their free cash flow, so that's why they added so much debt to pay their dividend payments. And it seems like they're increasing their dividend payment each year. This company has a pretty high beta, 1.88, so the stock moves a little less than 2 times the market. It is a bit volatile. The stock has increased 10% in the past 52 weeks. That's worse than the S&P 500, which increased 17% in the same time frame. The 52-week low was $7, the high was $25, and the stock is trading above its 50-day and 200-day moving average. About 2 to 2.5 million shares are traded each day on this stock, and of the 1 billion shares outstanding, only 389 million are on float. 29% are held by institutions. A little under 5% of the shares on float are shorted. If you invested $10,000 into this company in 2012, you could have sold for triple your money, but if you're still holding on, you'd be at $15,000 today. That's a 5% annual return. The reason the company has such a low float is because their parent company, Marathon, owns 62% of the stock. The next biggest shareholder is Blackstone, then Harvest Fund, Invesco, and last is Alps. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income from that large asset impairment, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 3.1, so investors are paying $3.10 for $1 revenue. That's a pretty good price to sales ratio. Price to book is stock price over book value per share. They're at 2.0. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $13 billion of equity, $5.2 billion of tangible equity. since they have $8.6 billion of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 4 times. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can cover 80% of their current liabilities with their current assets. So it does look like the company's undercapitalized. They did produce $2 billion of free cash flow, but they have negative $259 million of working capital and a $2.9 billion dividend payment. So they're short $1.1 billion. So they're probably going to add more debt to get through the next 12 months. The best way to look at ratios is to compare them with similar companies. I've done videos of 44 midstream companies, and the average is here. MPLX is right here. And MPLX is doing worse in PE because they're negative. They're also doing worse in price to sales and price to book because the average is so good in this industry. They're doing worse in current ratio, worse in ROE. They're at the average in debt, but they're a much bigger company than average at 26 billion market cap. Average is 9 billion. And they do pay a higher dividend at 11.2%. Average is 10.4%. This industry pays a massive dividend. So to summarize, I have them trading at a 21% discount. This is one of the larger midstream companies. Midstream companies do provide a very necessary product, oil, which is so important for our everyday lives. And they also pay a really nice dividend, and they haven't been cutting their dividend. So if you're looking for a dividend stock, this could be it. I rank their free cash flows 9 out of 10 because they're growing them quite a bit each year. I rank their revenue 8 out of 10. It grew a lot from 2017 to 2019. It did dip a little in 2020, but most companies had lower revenue in 2020. And I rank their ratio as 3 out of 10. They're a bit weak, especially against their peers. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.